Hello again. Welcome to the series of video that we are recording for capital budgeting. This, I think for Corporate Finance 1, the base level course is perhaps going to be one of the last videos where we will be talking about something super important concept of how to map the cash flows for a project. Now, this is the second time I have said super so many times. The first one being when we were discussing the concept of the techniques of capital budgeting, where NPV, IRR, and stuff like that came up. Why is this one, the mapping of cash flow, so critical? Is because that's where the difficulty lies. That's where that's a place where most mistakes are made. That's where which is which will call for a prowess by an MBA student. So I just wanted to kind of spend 5-7 minutes on to give you some basic principle of how do you map the cash flows of a corporate project. Okay. Let me begin by telling you that it's not the first time that you are going to map the cash flows. You have mapped it many times. While we were doing the cost of capital, remember, you had drawn out the coupon interest, and then you have mapped it at different time zones, and then you also looked at the principal amount which will be redeemed. Remember, we used to call it par value. So all of that being mapped, and then you have to apply some rate formula, etc., etc. So what you do after that is not the point. What is the point here is that that there was a string of cash flow related to a particular instrument that was mapped according to different time zones. That's exactly what mapping of a cash flow means. All right, so that's a good news that we are not going to do something radically new. It's just that now the context in which we have to pick this up is going to be a bit different, because back then it used to be a financial instrument such as a debt or an equity for that matter. But now it's going to be hardcore capital project where it will be as real as life can get. So visualize a Tesla planning to enter an Indian market to set up shops, okay, set up a factory. Now, what kind of cash flows would it entail? Now, you see, it's such a complicated case, and it'll have ramifications coming from, buying land. And within that, there will be multiple cash flows. You have to pay to the broker, pay to the government authorities, you have to pay for stamp duty, registration fees, and then, of course, to the seller of the land, etc. And then you have to start building on it. So you have to pay for the construction, you have to pay for the cement, you pay for the bricks, etc., etc. There's a whole Pandora box out there. And then you will start constructing the factory, bring in the equipments, you have to draw the conveyor line, you have to fix up a lot of nut bolts, etc., etc. So you can imagine that so much detailing needs to be done in real life. That's where, in the previous video I had mentioned that when you're out in the practice, that's where the difficulty is going to be. That's where you're going to spend your 90% of your time and effort in doing it, mapping the cash flows. So in this video, I just want to, kind of lay down a few principles, and here they are. Okay. Keep a corporate project in mind while you're looking at these points, not a financial instruments typically, although we have said it many times that some of the principles will also be applicable to a financial instrument. All right. So my question is, let's say Tesla buying a factory in India. All right. That's the context. How should you go about taking that decision? First of all, should Tesla enter India or not? If that's the question, you have to look at the whole thing on the point of view of the cash flows, not on the basis of the accounting income, such as a PAT or a per share, which we also know as earning per share. Okay, so there are different type of accounting income. You have EBIT, you have EBITDA, you have gross profits, you have before tax profits, you have after tax profits, and you also have a per share in form of earnings here. All of those are accounting. Okay, now accounting is accrual based, and we all know in financial accounting that it's very manipulative through provisioning, through over provisioning, under provisioning, changing the method of inventory from LIFO to FIFO, or adding some extra depreciation by way of WDV versus SLM. All those accounting policies can have an impact on your accounting income. Therefore, when we are taking a decision, it's about real money that is involved, not just a post-facto reporting. Therefore, we base ourselves in cash. And you see, in corporate finance, we also have a point where we say that cash is the king. So this is where the cash comes into the picture. The second principle is that we got to analyze all the cash flows from an after tax basis, which means, and in our class, we sometimes create a joke that all the finance managers are actually wearing a spectacle, and the spectacle carries 1 minus t on it. You see, so when an individual, let's say, buys a coffee worth 50 rupees, it's 50 to that individual, but to the finance manager, he doesn't see a 50. What the finance manager see is 1 minus t. So the tax rate is 30%. So 50 rupees minus 30% of this 50, effectively 35 rupees is the cost of that coffee to the finance manager. Everything that he sees is after tax. You know why? Because the finance manager has to worry only and only about one fellow called as a shareholder. And shareholder, in the scheme of things, in the priority of things, get the value, get anything in terms of profit or return only after paying to the government. So I'll take you back to your income statement where we had gross profit minus operating expense to EBITDA minus depreciation is EBIT, minus interest is profit before tax, minus taxes is profit after tax. This goes into the pocket of the shareholders. That means government has already taken and collected their share. Also think of it that way. If a country has a 20% tax rate, isn't that country making a point that the government is a 20% shareholder of that business? Whatever profits are going to be made, 20% is taken by the government. That means government is a shareholder, a passive, an implicit, a tacit shareholder. And whatever is left after tax, 1 minus t, 80% that is, only this amount goes to the shareholders of the firm. Meaning thereby, long story short, all incomes and expenses from a finance manager standpoint, doesn't matter only here, but everywhere, in corporate finance is always looked from an after tax point of view. Okay. The third and a very obvious thing is that we always got to involve time value of money, because the value of money will change over a period of time. 100 rupees 5 years later will not pinch me as much as paying that 100 rupees today. So in case you have cash flow spanning across time zones, which will definitely be the case in case of capital budgeting, please make sure that you involve time value of money. All right. Fourth point, always take decisions on the basis of cash flows. Nothing new, no, but on the basis of incremental cash flows. And at this point, this is something that we'll have to debate further in our live class. But remember, there were two projects called as independent projects, and there were mutually exclusive. All right. Independent projects are one where A did not compete with B. It was A and B as well. There's a possibility that both had to be good. In case of mutually exclusive, it is either A or B. That was the deal. All right. Now, point here, incremental cash flow is more relevant when we are discussing mutually exclusive projects. So when we are saying that I have to evaluate whether A is better over B, then I'm going to look at incremental cost that I have to spend as a business while acquiring A versus, and I have to compare that incremental cost with the incremental benefit that I'm going to get if I get access to A. So A, imagine, um, is a project, let's say, to for Tesla Motors. Project A is go and set up shops in India, and B is go and set up shops in, for example, Brazil. So what extra cost will it take? So A is an India project. So what extra cost will it take to open up a factory in India? And this extra cost will have to be compared with the cost incurred in Brazil. So India minus Brazil is going to be the incremental cost that you have to set up in India. And this incremental cost needs to be compared with incremental volumes that Tesla will be able to derive if they set up shops in India. So incremental benefit and incremental cost needs to be compared while you arrive at the incremental NPV. Okay, that's where this mutually exclusive concept comes into the picture. For independent project, incremental doesn't hold as much value, because in any case, I am not bringing A in context to B, nor am I bringing B in relevance to A. I'm evaluating A separately. So the decision that I have is, should I go for A or not? Should I go for B or not? So here, the other thing that I have to compare with is doing nothing. So A minus 0 is actually going to give you the cash flows from A. So therefore, the incremental approach doesn't work as well. That's not required that much when we're talking about the independent project. Okay, like I said, more on this when we talk about the live classes. And you see this numerical, we are going to pick this up right up through Excel in the live class. Okay, next principle, very important one, is let the bygones be bygones. You cannot change the past. And if you cannot, that should not have a bearing on your decision making. In finance, we call these costs as sunk cost, something that have already been sunk, something that is not going to change, something which you cannot alter with your decision making. So imagine a situation where you have to, so I have an example right here. Let's say you want to launch a product. So the question here is, should I launch or not? But by the time you arrive at this decision point, you already have paid 50 lakh rupees to a marketing firm. So what is your option A? Should I launch this product? Okay. What is your option B? I do not launch. Think about it. In both the cases, I have already incurred 50 lakhs. So 50 lakhs spent here, 50 lakhs spent here, because 50 lakh has already been spent before I come to this decision point. I am standing here and I've already incurred 50. In any case, in both the option, I'll have to show a negative of 50, an outflow of 50, which incrementally, remember we have to look at incrementally, it will have no impact. So if something is not going to matter, why should I bring it up in my analysis? That's forward-looking approach. Decision making in finance is always forward-looking. You don't have to worry about what has happened. That's for the accountants to do, which you were, in one of the previous trimester. But here in corporate finance, you are a hardcore decision maker. You're only going to look forward. Okay, that's where sunk cost needs to be ignored. The next principle, number 6, is on externality. Okay. Uh, Let me take an example about what an externality is. Take a company such as Hyundai. Okay. Hyundai Motor India has been doing fabulous job in India, coming out with brilliant products such as a Santro, an i10, an i20, Accent, Creta, Venue, Alcazar, and so on and so forth. Okay. Now they are planning to relaunch, let's say, Grand i10. Okay. So the decision is a product launch. Okay. Product launch is new NIOS I10. Should I launch or not? This is the decision point. That's a capital project. Okay. Now, while you are going to do as Hyundai, you're going to look at the benefits and you're going to look at the cost. One of the cost is going to be the R&D expense. The other cost will be the material that you'll have to incur. Other cost is going to be the setting up of a assembly line, perhaps not the entire factory, because factory that would already be there because you're all existing player in the market. But let's say setting up an extension of that assembly line where this specific new product can be assembled, some new technology that you do. All of these will be the explicit cost related to the project that I am in, NIOS I10 to be launched or not. But hey, there will be an indirect cost also that Hyundai will have to bear. What is that? It is the cost, or it is the loss that may happen on other product sale, which will go down because people will now be excited to buy an iOS i10. So think about it. if I were anyway would have bought a Santro, but I am now not going to buy a Santro, but buy a new i10, that means the sale and the profit of that Santro is going to go down. And therefore, while I'm evaluating the decision to launch my i10, I have to also look at the loss of profit on existing product of the firm. This clearly is something which is outside of this project, but still within the firm. You see the difference? It is within Hyundai, but still outside of i10 project. This is externality. Externality doesn't mean something outside of the firm. Obviously, Hyundai would like that customers of Maruti should shift. Customer of Tata Motors should shift, but Hyundai would not want the customer of Santro to shift. So this loss of profit that otherwise would have been made in form of the profit through Santro would also have to be counted as a cost when you're launching it. Don't go home thinking that externalities are only negative. That's called as cannibalization. Okay. There's a marketing term that you're going to also study in your marketing. There are some positive cannibalization, also positive externalities also, meaning thereby, let's say a, a, um, a restaurant, okay, which is selling only pizza, such as a Pizza Hut. Now, when this, let's say, start to sell some ice cream also, so imagine there is on menu, there is a pizza and then you add ice cream as well. Now, anybody who will enter to buy ice cream may be lured to buy a pizza also. Anybody who is entering to buy a pizza may be lured to take an ice cream also. So the decision is whether to launch an ice cream or not as a product. That's your decision point for Pizza Hut. While you're evaluating the benefit and cost, within the benefit, you have to look at extra sale of pizza. Because otherwise, if people would not have wanted to buy ice cream, they would not enter the restaurant at that point in time. And therefore, no point of making that sale of pizza. So that pizza got sold, okay? And this is not true for entire pizza sale. People will enter Pizza Hut to have pizza. That's not externality for ice cream. Externality is only those units which will get sold because people entered the showroom to buy the ice cream and they end up buying pizza also. That's a positive externality. So externality is something which is within the firm but external to the project that we are looking at. All right. So the clear understanding of the project also is important. What is the decision that I'm looking at? All right. One of the two last principles here, the seventh is the working capital investment. Working capital, you must be wondering, why is this part of capital budgeting? Is this not a separate decision, investing decision? Of course it is. And we will talk about it in when the machinery is already up and running, when the firm is already up and running. The point that I'm driving at this moment is that this working capital investment is connected to the new machinery that we are planning to buy. So imagine a situation that a business wants to buy a cab to fly children from their homes to the school and then back. And that business does not have any cab for now. So it's like an expansion project for them from a 0 to a 1. And therefore, the cab cost is about, let's say, 5 lakh rupees. Now, this 5 lakh is not going to be enough to start doing the business, because in 5 lakh, all you're going to get is one cab. But hey, the collection from customer will happen only at the month end. Who's going to fund for the petrol during the first month? So you see that on the first day, not only the business needs some money to buy the cab, you also need money to put in some petrol. You get this point? So at T0, while you are evaluating, should I buy a particular cab or not? That's a capital project. You are also going to include the cost of petrol that it is required by the business to be invested in so that the cab can run for the first month. Why only first month? Why not every month? Because the fee collection from the parents that will happen at the month end, the first month end, will be enough to fund, and we're hoping that it's enough, will be enough to fund the petrol for the second month, let's say February. So February's petrol does not have to be put in by the capital providers. It comes out of the cash flows generated by the project itself. So the only petrol that you have to buy from your pocket as equity and debt is the initial first month's petrol, because then the January's collection from customer is going to fund the February's petrol. February's collection is going to fund March's petrol, and then November's is going to fund the December's petrol. So likewise, the cycle will continue. That's why it's called as working capital. It will always rotate and revolve all the time. But you must be wondering, is this is the initial amount that we have put in. Is there a point where this amount will be returned back into the pocket, will come out of the project, go into the pocket of the capital providers once again? It will only happen when you decide to shut the project. It means when the project ends or when the company ends. So think about it. The same company decides that from January onwards, the next January onwards, after flying the cab for a year, they will stop the business. That means they're going to do the business only for 12 months. So in the first month beginning, they have put in extra money as petrol, working capital. That's going to be an outflow at T0 today. But then there will be the outflow required for the second month will come out of the first month, and likewise the chain that we have said. Now, at the end of the 12th month, you will have some collection coming from the customers. But then you do not need to put in petrol for the 13th month because you're going out of business. That means at the end of the 12th month, you have some cash coming out from the customers, which is not required to be pumped in the 13 months requirement, because there is no 13 month in your life. That is a point at which you can collect and take the money out and put it into the pocket. That is a point at which the project will generate an inflow. So for working capital, life's pretty straightforward. So what you have here is an outflow is going to happen, and the same amount will get released when the project ends. So in your capital budgeting exercise, you will have situations like a machinery being purchased for 5 years or for 10 years. So today, invest that amount, show it as an outflow along with the purchase cost of the machine, and then release that exact same amount upon project maturity. Don't do the mistake of investing 100 and recovering a 240, adding time value of money. That's not going to be the time value of money. Okay, there is no time value of money in day-to-day stuff, which is your working capital. So your 100 being invested, you are going to recover 100 only. Okay, so in the pre-watch video, this is enough. In my live class, I'm going to draw some patterns and add some complications in this. Like this amount that you have to invest, not necessarily it will get invested all at once. If a company is expanding over 5 years, then every year to fund the expansion, you will have to invest some extra amount in working capital. So you might have a situation where your outflow is not entire 100 at once. It is 20 at the beginning of the first year, 20 at the beginning of the second year, 20 at the beginning of the third year, and likewise. So the total amount that you have pumped in as working capital is staggered across. There could be one of the cash flows like that. So you have to be very business oriented when you're doing corporate finance. All right. So the treatment that you got to do, remember that show that as an outflow today, T0, and show the exact same amount as an inflow later on. And the last principle that I have, which is again going to require a lot of discussion in the live classes, is on the role of taxes, which means, and the tax, I don't mean the indirect tax, I mean the direct tax. This is the same tax which is being written 1 minus t, and now everything is visible on a 1 minus t basis. So this is the same income tax that I'm going to refer to. And this is also to say that this slide is not going to make any sense if the question says ignore taxes. Okay, so here you have a situation where a business is dealing with some kind of a tax rate, let's say a 20% tax rate. Okay, now this tax rate or 20% means what? That 20% is the implied shareholding of the government. That's what we discussed, all right? In which case, if there is a gain, government is going to take that 20% out. So it will be an outflow from the business. But if there is a loss, government is going to bear that loss as well. So there will be a tax saving that I will enjoy as a business in a way that I don't have to pay 20% to the government. Okay. Now, this is where you have to understand it a bit. Let's say I am doing my business A, and then there is a business B as well. Think about it. If business A incurs a loss of 40 and B incurs a gain of 50, the overall gain that the company will write in their income tax return is 10 times or 20% is just $2 of taxes that the company has to pay. But hey, why $2? Uh, this 20% qualifies for a $10 taxes. Why did you just pay two? How were you able to save this $8? You were able to save this $8 because the loss in one project has been able to set off the income from some other project and therefore resulted into some tax saving. So the way we look at in finance is not at a total level. The way we are going to look at it that this project is going to result into a tax saving and this project is going to lead to a tax payment, and therefore after tax cash flows are going to be like this. This is before tax, this is tax, and this is after tax. That's how a finance manager behaves when they deal with taxes. So income taxes have to be attached individually to different projects. The long story short, even in case there are losses, the government will not withdraw and will continue to honor their 20% shareholding by giving me an implied tax saving. This 8 is not in form of a check that I'm going to get from the government. Don't get confused. Net net, there will be one single check of $2 on a reality basis. But the reality is not what we are discussing here. We're discussing some forecast situation. So we want to evaluate project A very specifically. Because of A, I'm able to save my $8 of tax. So I must give credit to A for saving this $8. So the same logic I can apply when I make a sale of a machinery. Now, this whole capital budgeting is, should I buy this machinery or not? But after the maturity, you're going to sell the machinery. Now, upon the sale, there may be a gain or a loss. So make sure that the correct rate of tax is applied to that gain or loss in case you're making. So in case you're selling the machinery at a gain, then you got to pay some tax. In case you're selling the machinery at a loss, add some tax saving, and your total cash flows that you're going to consider is going to go up to that extent. Okay. It's ironical initially to say that, on gain, my cash flows are going to go down by the tax payment. On loss, my cash flows are going to go up because of tax saving. But that's how, you have to appreciate and understand this whole thing. Really, the last part is the role of depreciation. This is a super fabulous concept, and I really need a lot of time to explain this in the live class. But the concept is very similar and very simple to what we've discussed so far. Basically means that anything that I see here is on an after-tax basis, all right? That means any expense, because it reduces my taxable income, results into a tax saving. So an expense of 100 will save my tax to the extent of 20, and therefore I will see a net expense of just 80. So this part is the tax saving happening in the life of the business because of the expense being tax deductible. Okay. Now imagine a situation where an expense is non-cash. Because it's non-cash, but nonetheless it's an expense. So it reduces your taxable income. It results into a tax saving. But actual cash outflow doesn't happen because the expense is non-cash. Welcome to the world of depreciation. Depreciation, you don't have to make payment to anybody. But nonetheless, it reduces your taxable income. You save on taxes. So the only role that depreciation will have on the project is a positive 20. What do you mean by this positive 20? The amount of depreciation times the tax rate. This is going to be the saving in the life of the business in terms of the cash flow because of an element called as depreciation. All right. Depreciation being a non-cash expense doesn't involve payment of this full 100, only the tax saving. The $20 is what you will save, and therefore the net cash flow that will happen in our life because of depreciation is going to be a tax saving of a 20%. All right, because otherwise it creates a confusion in our mind as to if depreciation is a non-cash expense, what is it doing where only the cash flows are being counted? Remember, my first principle was that only the cash flows are to be counted. It's corporate finance. Depreciation is non-cash, out and out, a hardcore non-cash expense. But here is a merit that because a non-cash expense can also result into a change in the taxable income, it can impact my tax payment or tax receipts, and therefore only to that extent of the tax impact is going to be the importance of depreciation in capital budgeting. Remember, if the income taxes are zero or the question says ignore taxes, then all of this discussion about taxes that we have done is not going to matter. All right, everybody. So with that, we are at the end of this video. A little longish video, I understand, little complicated video. We have touched upon, 7, 8 very robust, very important, very strong principles. But you see, that's where the difficulty is going to be. So I have a wonderful case with which I want to explore all of these concepts with you. It's going to take a while to appreciate a few of these principles. Some of them are going to be very quick, but I'm sure that we have all the patience. We have time in our live classes. If you have seen the pre-watch video very well, then we will be able to hit the ground running, from the first minute itself, and we will be able to master all these fantastically. So with that, thank you very much for watching this. I will see you in the live classes very soon.